Respected today resource person, B. Sankaranarayan sir, dear faculty members, research scholars, students, other participants, very good afternoon all of you. Today topic is input tax credit. This session may be discussed and demonstrated in practical way with examples. The session will be more informative and brainstorming to the enthusiastic participants. I am sure that you all will feel enriched with knowledge after completion of today's sessions. On behalf of Bharathiar University, I feel honored to welcome resource person B. Sankaranarayan sir, Chartered Accountant, Chennai, for giving a lecture in 6th day sessions. I personally thank you very much, sir, for accepting our invitation with your busy schedule and professional work. I am also delighted to introduce the resource person, B. Sankaranarayan sir. He is qualified chartered accountant and cost accountant with 1.5 decades experience in financial and taxation compliances spanning across diverse sectors including bank, service and manufacturing sectors. He is a member of GST study group of ICAI. He is a contributor as part of ICAI team in charge of preparing and updating background material on GST. He is a master trainer of GST affiliated by Institute of Chartered Accountants of India. He has he has trained more than 2000 chartered accountants and 6000 finance and accounts professionals across India on GST law and practice and indirect taxes. He is a member of Governing Council and Secretary of International Chamber of Indirect Tax Professionals. He is also a member of Indirect Tax Committee of Hindustan Chamber of Commerce. He is a co-author of the book namely Gain Smartly Through Senvat Credit Rules 2004. He has acted as a speaker and trainer on taxation at various institutes like Institute of Chartered Accountants of India, Institute of Cost Accounts of India, Institute of Company Secretaries of India, Nidhi Aayog Initiative, Commercial Tax Staff Training Institute, Tamil Nadu, National Academy for Customs Indirect Taxes, Narcotics, Chennai. He is a founder partner in GPVS and Association, Chennai. He has also acted as a resource person for the RUSA sponsored 10 days online national skill development program on GST, registration, assessment, filing of returns, base 1 and base 2, conducted by Department of Commerce and Bharathiar University. That's a resource person today with us. This is the great opportunity is offered by Bharathiar University under RUSA. I trust you that everyone can enhance your skills and knowledge through this program. I heartily welcome everyone. I thank you all for your kind cooperation for this success of program. Now I heartily invite the resource person to deliver lecture in the today's sessions. I welcome you, sir.
Thank you. Thank you, Sri Jagdishwaran sir, for that elaborate introduction. Happy to be associated with this initiative one more time. GST, as we all know from, I think, 2017 July, two things are very famous. One is Big Boss, other one is GST. So not even a single day of our life we would have spent without mentioning this word GST in a good way or in a not so good way, but still that is the law of the land. And for finance professionals, it is all the more important to make themselves conversant with the provisions of GST, because 80% of the work of a finance professional revolves around GST. Whether it is raising of invoices, booking of expenses, statutory liabilities, ascertainment of income, everything is driven or is fulcrum. The main fulcrum is GST. It revolves around that. Hence, it becomes imperative for any finance professional not to skip GST, but to say that yes, I have the requisite skill in GST, and it is something which is very useful for us also, for the reason that earlier people used to say software companies, they were in a spree to recruit. So if somebody trespasses, we'll see a board, no, normally in places that trespassers will be prosecuted. But in a software company, trespassers will be recruited. That is how they used to say. I think a similar situation prevails for people with knowledge of GST. Even before this meetings start, I had a call from one of the clients asking for, sir, refer me a GST knowing person, a tax knowing person, be it at a middle management level, junior management level, or an apprentice, anywhere. This knowledge is very, very, very important. Now, that is to get you into the topic or lead you into the topic by way of giving the importance of how practical it is. It is not like you read something and you'll have to wait for a period to put it to practice. You can do it immediately. That is how quick GST is, or that is how practical the subject is. You learn that there are 4 different rates and this is how it is collected. There is a composition taxpayer. How does it happen? You buy from a person who shows GST number but doesn't charge you tax. You know that that person is a composition taxpayer. So how do I know he's a composition taxpayer? Take the GST number, search in GST portal. Can I search without GST registration number? You need not be a registered person. Still, you can search and find out. So that is how current, that is how dynamic this subject is. And for finance professionals, it adds value because learning is one side giving you knowledge, and also it is creating you revenue. You should keep both in perspective. Now, inside the GST, there are various parts, which some of it would have already been covered, and the remaining would get covered in the days to come. In this, the key aspects, 2 aspects which I wanted to discuss. First part will be on the reverse charge mechanism, and the second part will be on the input tax credit. The input tax credit by itself is called as a beneficial piece of legislation in GST. Why is it called it is beneficial, or what is the benefit that one derives from input tax credit? Suppose I am a trader. I am buying goods at 100 rupees. I have to pay GST of 18 rupees. So I buy the goods paying 118, but is 118 my expense? For this question, the answer is a resounding no. That is where a finance professional will understand all the outflows need not be my expenses. It's an outflow. There is no denying that. 118. But 100 can be my expense, but 18 rupees is what is known as input tax credit. So who has given you the right? The government has told me when they introduced GST, one of the main cornerstones of GST was whatever tax you pay, I will allow you to take it as credit, so that when you become liable to pay, you can offset it against the tax that has already been paid. When I procured for 100, I have paid 18 rupees GST. This 18 rupees I'll accumulate in my books of accounts under current asset by naming it as input tax credit. Now, what is the next step? When I have a liability, the items which I procured for 100 rupees plus GST, I will make a sale. I am selling it for 150 rupees. On this 150 rupees, again 18% GST would come to 27 rupees. Now I'm liable to pay 27 rupees of GST. Should I pay 27 from my pocket? From my customer, I will collect 150 rupees for the basic value plus 27 rupees. So my inflow will be 177. In that 177, 27 pertains to GST. Should I now pay it to the government? You need to pay 27, but hold on, you already have 18 rupees in your account. Where did that 18 come from? When you procured, you paid that 18. So take that 18, take this 27, reduce this 18 from 27. All you need to pay is only 9 rupees. So what has happened here is, you have first given away 18 rupees, you have collected 27, offset, and you have retained that amount with you, the 9 rupees. So, sorry, you would have paid that 9 rupees only to the department. So, in effect, the taxpayer under GST is not the one who is bearing the burden of tax. because I have simply collected 27, I have retained 18 because I have already paid 18, and I'm just going to pay 9 rupees to the department, which means I collected 27, I dispatched 27. The 18 was already paid, so hence I retained it. This 9 I would have paid to the government. So if anybody says that GST rates are higher, certainly it cannot be the taxpayer, because the taxpayer is only a postman. He just collects the tax and pays it to the government. How can that person say the tax is higher as long as the consumer doesn't say? The consumer is the person who bears the brunt of the tax. So he is the one who is supposed to say whether it is high or not. Now, this element where I avail the input tax credit, I take the benefit from the government. That is what is the majority of the discussion that we are going to have today. Now, let's get into the presentation. As I said, we are going to first have a look at the reverse charge mechanism under GST for a few minutes, and then we will progress into input tax credit. The concept of reverse charge mechanism, how does it happen in GST? This is called normal charge. What is the normal way of collecting indirect tax? There will be a supplier. He will supply the goods to the recipient. He will supply the basic value plus tax to the recipient, and then the recipient will pay the money, the basic value plus tax. So what will happen is the supplier will have to pay the tax to the government. Whatever he has collected from the recipient, he will retain the basic value. That is what is generally the methodology in which indirect taxes work, and we call it as normal charge. Why we call it as normal charge? Because something different was introduced, which is named as reverse charge. Here also, there is an element of tax. The tax is reaching the government, but the person who pays the tax to the government is not the supplier, it is the recipient. It is from that angle, this is different. I am a supplier, I supply goods, and for those goods, I charge a value. Now, for these goods which I have supplied, the recipient will have to pay the tax to the government. The recipient will have to pay the basic value to me. That is his contractual responsibility. Legally, he is bound to pay the tax to the government. Look at the difference. The supplier collecting and paying is ideally indirect tax. So they are going in the opposite direction. That is why it is called a reverse charge, which means the recipient is made liable to pay. The recipient is paying the tax. Now, it is very clear that not both of them are paying on the same transaction. It is a type of transaction where the government legally notifies, mentions that these people will have to pay under reverse charge. It means in those cases, the recipient will have to pay. The supplier need not pay. So if you look at it from a tax perspective, there is only one tax. But the tax who pays matters, and when the recipient pays, that is when it is called as a reverse charge. Now, this reverse charge concept legally is there in two places in GST, 9 subsection 3, 9 subsection 4. Now, what is this 9 subsection 3 and 9 subsection 4? Two sections which dictate how this reverse charge mechanism should happen. 9 subsection 3 is called as notified reverse charge. It means the government has notified a list of goods and a list of services. For these goods and these services, they have clearly said that it is the recipient who is liable to pay GST under reverse charge. So it doesn't matter whether the recipient or the supplier, both of them are registered or unregistered, the responsibility is cast upon the recipient. Supplier registered doesn't matter. Supplier unregistered doesn't matter. These goods or these services which gets covered under 9 subsection 3, it is the recipient who is liable to pay GST. On the other hand, if it is going to be a situation of 9 subsection 4, which is unregistered persons making supply, and you are a registered person who is receiving the supply. I am a registered person. I am receiving goods or services from unregistered person. The government says, okay, in this case, We will not tell everybody. We will tell a type of business. In that type of business, that person who is a registered person who is receiving goods or services from unregistered person will have to pay GST under reverse charge. So here, only when the recipient is unregistered, rather only when the recipient is registered and the supplier is unregistered and the recipient's business has been notified as a specified type of business, in that case only this 9 subsection 4 reverse charge will occur or arise. As of now, this 9 subsection 4 reverse charge is notified only for the construction business, the builders. So these builders who are registered people, they might be hiring unregistered people for rendering services. They might be procuring goods from unregistered person. These type of business, that is the builders, they are liable to pay GST under reverse charge. Because you are procuring from an unregistered person and you are liable to pay under reverse charge. So this is not applicable for everybody, because when GST was introduced from 1st July 2017 till 18th October 2017, the provisions of 9 subsection 4 was made applicable for everyone. But subsequently they have curtailed it by saying it is applicable only for a type of industry, which we will notify, and they have notified from 1st April 2019 the real estate industry as the industry which will have to take care of this unregistered person inward supply reverse charge. So this unregistered person reverse charge supply as of now is applicable only for one industry. Now we will focus on 9 subsection 3, which is the notified reverse charge. Whenever we receive these notified goods or these notified services, we are liable to pay GST under reverse charge. Who are we? We are a taxpayer under GST who is registered person. Now 9 subsection 3, what are the goods which are covered, which if you procure, you are liable to pay under reverse charge are 1. Raw cotton, cashew nut, tendu leaves. As you can see, raw cotton, cashew nut, tendu leaves are all agricultural produce. Now when I say cashew nut, they are not mentioning the cashew nut which is ready to consume. The cashew nut which is just grown, which is harvested from the plant. That is the one. So here they have also levied a condition that when these are procured from an agriculturist, that is when the reverse charge will arise. So if I go and buy cashew nut from a trader, from a shop, there is going to be GST. There is no reverse charge. He is going to charge me. Only when these are procured from an agriculturist, reverse charge will come in. What is tendu leaves? Tendu leaves is the one which is used for wrapping the bidi. That bidi leaf is called as tendu leaf. So there also it is the procurer who will be, in all probability, will be a bidi manufacturer. He will have to pay GST under reverse charge. Lottery tickets. In India, only in 2 states, lottery tickets are legal, being Kerala and Sikkim. In these 2 states, the state government itself prints and circulates the lottery. Now, in these states, the lottery tickets which are procured from the government by the distribution channel, the distributing people, they are liable to pay GST under reverse charge. So whoever is procuring the ticket, the middleman from the government who will subsequently sell it to the end consumer, that middleman is liable to pay GST under reverse charge. And then silk yarn, again horticulture item where from the silk worm the silk yarn is extracted. That silk yarn, when I am procuring it, I am liable to pay GST under reverse charge. Must be a fabric manufacturer. And whenever I am procuring used or seized goods from government, I am liable to pay GST under reverse charge. So the police department captures any vehicle, after some time they auction it. The customs department seizes goods, they auction it. The GST departments themselves, they confiscate goods of people who have evaded tax and subsequently they auction it. You go and procure it in the auction. You are liable to pay GST under reverse charge. Sir, I am procuring all the garbage from the corporation. That is also goods. You are liable to pay GST under reverse charge. And tobacco leaves, like tendu leaves, tobacco leaves, if you are procuring from an agriculturist, you are liable to pay GST under reverse charge. Moving further, the priority sector lending certificate. The priority sector lending certificate is a certificate which is unique only for banks. The banks, when they lend to the customers, they are supposed to lend based upon a particular sector wise. They have to split their lending, where some banks might lend more to the priority sector, some may not have lent that much to the priority sector. In those cases, the government allows such people who have lent more to the non-priority sector to procure the priority sector lending by way of converting it into a certificate, the priority sector lending certificate, and procure it from the person who is ready to convert it into an instrument and sell. So the seller here also will be a banker, the buyer also will be a banker. The priority sector lending certificate is the goods on which the procurer is liable to pay GST under reverse charge. Now moving to the next part, the services on which, irrespective of the service provider's status, whether he is registered or unregistered, the responsibility is on the recipient to pay GST under reverse charge. The services being import of service, where any type of service, if I am procuring from outside India into India, I am liable to pay GST under reverse charge because the supplier will not be in India. Hence, I will have to pay under reverse charge. Goods Transport Agency, GTA. These are people who transport goods by road within India. And for the transportation, it is not mere transportation. They do some additional activity also, which is assumption of responsibility. That is why they issue a document called as consignment note. So they transport goods by road and they issue a consignment note. They are considered to be a GTA. And when we take their services, we are liable to pay GST under reverse charge. When we take legal services of a lawyer, it could be any type of service which is legal in nature, connected to law, and it is rendered by a lawyer. We are liable to pay GST under reverse charge. And then any services by a arbitral tribunal. Arbitral tribunals are the ones who resolve disputes between organizations. They mutually agree because they don't want to take it to a court. Instead, they want to settle it in a arbitration procedure, the alternate dispute resolution mechanism. As per that they want to do it, the arbitral tribunal will be ready to help them. The fee that is paid to the arbitral tribunal, the person who is paying the fee is liable to pay the GST under reverse charge. And then sponsorship. Any kind of sponsorship services which are rendered by a person to the other person, we are liable to pay GST under reverse charge. The recipient is liable to pay GST under reverse charge. Now, sponsorship fee is a bit technical and can be confusing at times because sponsorship fee, let me give an example, the practical example of, we see the cricket matches and all we see is the bats of cricketers will contain the stickers. Let's say Virat Kohli's bat contains the term MRF. Now, is that company MRF, Madras Rubber Factory, are they manufacturing bats? Certainly not. They want their name to be put on the bat. So Virat Kohli is the one who's rendering the sponsorship service. The supplier of service here is Virat Kohli, but who's the recipient of service? MRF. Now, who's liable to pay GST under reverse charge? MRF. A title sponsor, Dream 11 IPL, who's liable to pay GST under reverse charge? Dream 11. Because Dream 11 is the recipient. IPL Private Limited is the company which is the supplier of the service. They allow him to sponsor the event, but who's the recipient? Dream 11. They are liable to pay GST under reverse charge. And then services which we receive from government, like any approvals, any allocations. For example, licenses we get from the government, license to operate, license to mining, or license to conduct industry. All this, when we get the approval from the government for a fee, that fee is for the services rendered by the government. And for that fee, we are liable to pay GST under reverse charge as the person who is receiving the services from government. And then services by a director to a body corporate. Ideally, a company will have a director. Now, there are two types of directors that can be there in a company scenario. One could be a whole-time director, a person who is taking care of the day-to-day affairs of the organization, or we will also call that as executive directors. And the second category could be non-executive directors. Now, when we say it is executive director, the executive director is a person who will participate in the day-to-day affairs, so he will be even paid a salary by the company. Those services are not what is being discussed here. This is not in the nature of salary, but it is still being paid to a director. Could be any kind of fee that is paid to a director, not in his individual capacity, but in his capacity as a director. In those cases, we are liable, that is the corporate which is taking the services of a director is liable to pay GST under reverse charge. And then insurance agency services. The insurance agent is rendering services to the insurance company. He is not rendering services to the policy holder. He will come to our place, he will take all the documents, but that is all are part of the services which he is rendering to the insurance company. So the insurance company will only pay him commission. On that commission, the insurance company will have to pay GST under reverse charge. It is not the insurance agent who will pay GST. It is the supplier is insurance agent. The recipient is insurance company. The insurance company will pay GST under reverse charge. Similar to insurance agency, recovery agency. The loan recovery agents appointed by the bankers, the recovery agencies. When they collect, they will be given a commission, a percentage. In those cases, that commission they will pay under, that is the banks will pay under reverse charge. And then ocean freight. Any kind of goods coming from outside India to India, the ocean freight on those goods coming to India, the freight, on that freight, GST is applicable under reverse charge. The person in India who is paying that freight, who is the recipient, will have to pay GST under reverse charge. And any services of a music composer, photographer, or artist. Let's say A.R. Rahman is composing music for, let's say, Leica movies. Who is liable to pay GST here? On A.R. Rahman services, the Leica, the producer, is liable to pay GST under reverse charge. A photographer is giving the royalty, that is, he gives the right to publish his photo on the front page of a newspaper or front page of a magazine. The photographer is the service provider, but the magazine is the service recipient. So the magazine will have to pay GST under reverse charge. The same applies even for any artist. By artist here, I mean not performing artist. These are artists who draw. And then any author, a person who is an author. In case of an author of books, there has been a recent amendment where the government has given the option to the author. Either the author can register and pay GST by himself, so it will go out of reverse charge. Or if the author prefers to stay away from GST, then it is the publisher who purchases it from the author, the right to publish. They are liable to pay GST under reverse charge on the services by the author. And then overseeing committee members. Overseeing committee of Reserve Bank of India, where members are appointed, and for those members, amount is paid for their contribution for their services. On that service, it is not the member who needs to pay GST. It is Reserve Bank of India who will pay GST under reverse charge. And then direct selling agents. Who are these direct selling agents? The ones whom we interact on a daily basis, or if not on a daily basis, at least once in a week, somebody will call us and try to sell us credit card, try to sell us a policy. Now, these are the people who are part of a financial institution who are trying to sell products, financial products to us. These direct selling agents, when they get a commission from the financial institution, the financial institution is the one who is liable to pay GST under reverse charge. A banking facilitator in the rural areas, these are people who will act as a connecting link between the bank and the customer. Their services, the bank is liable to pay GST under reverse charge. A person who is a business correspondent to a person who is working as a business correspondent for a bank. A person who goes and popularizes the bank in the rural area is called a business correspondent. That business correspondent has an agent. Then on that agent services, the business correspondent of the bank is liable to pay GST under reverse charge. Now, these are the major services. Adding to it from 2018, in fact, I would say from 1st January 2019, because the notification was given on 31st December 2018, security services. Security services. Now, these securities are the ones whom we generally see who stand outside the building, who guard the building or guard the asset. These security services, it is the recipient who is liable to pay GST under reverse charge. It is not on all security services. It is when the security service rendering person is not a body corporate. It is an individual partnership or HUF, then the recipient is liable to pay. But if the security service rendering person is a corporate, then it will go under normal charge. And any kind of renting of motor vehicle, renting of motor vehicle meant for passenger transportation. Again, if the person who is supplying the service is not a body corporate, the recipient is liable to pay GST under reverse charge. Maybe a company is hiring buses for transporting their employees or hiring cars for moving their employees. The person who is giving the bus or car on hire is an unregistered person. Then the responsibility is on the company who's taking the services from that person who may be unregistered but who is not a body corporate. For that reason, I am liable to pay GST under reverse charge. And then lending of securities. This is something which is new, which is happening in the capital market, where I can give my securities on rental. I am holding 10,000 say shares of Infosys, but there is another person who wants this on a loan basis. He will take it and he will give it back to me after a certain period of time. So I can lend it to them. For lending it, I will receive a fee. That lending fee is liable to reverse charge. So it is the recipient who is liable to pay, not the supplier. So these are the situations where we will see reverse charge mechanism. In essence, reverse charge mechanism means it is not the supplier, it is the recipient who is liable to pay GST to the government. That is why it is called as reverse charge mechanism. Now, how does it happen? For the procedural aspects, the payment has to be done only in cash. I'll repeat, when you are paying the reverse charge liability, the payment has to be made only in cash. We cannot make the payment by utilization of input tax credit. Now that is mandatory. And then the second aspect is that ITC, the input tax credit, cannot be used for making RCM payment. Now please don't get me wrong here. I cannot utilize ITC for making payment of RCM, but whatever is paid as RCM, if it is eligible, I can avail that as input tax credit. There is no bar on that. That is allowed. The next aspect is ITC. If whatever is paid as reverse charge is eligible, we can certainly avail that as input tax credit. And if the supplier of RCM is unregistered, then one procedural aspect will have to be complied by the recipient. The recipient will have to raise a document called as self-invoice. The self-invoice is the document which I raise on myself, saying that service is received from an unregistered supplier. So I am going to raise an invoice on myself and I'll pay GST on that. That is what is called as self-invoice. So these are the procedural aspects covering reverse charge mechanism. How to comply with reverse charge. So this is the first part of our discussion so far on reverse charge mechanism. So what we can quickly do is see whether any questions are there on the chat box. No questions are there. Then I can get into the input tax credit discussion. Okay, directors. Is it sitting fees? Yes. What is paid to the director can also be in the nature of sitting fees. Yes. For that also, we are liable to pay GST under reverse charge because it is paid to a director. The body corporate which is paying it to the director is liable to pay GST under reverse charge. Yeah. Then I think we can move into the next aspect of our discussion, which is input tax credit. Now, this concept of input tax credit, why is it important? How does it happen? Now, look at this mathematical scenario. Before GST, this is how things happened. There was a manufacturer 1 who sold it to manufacturer 2, and then manufacturer 2 sold it to a dealer. And from the dealer, we procured it. I've taken a simple value chain. Manufacturer 1 is selling the goods at 1000 rupees. And he used to charge excise duty of 12.5, VAT at the rate of 14.5, because this is prior to GST. Selling price would come to 1,288, wherein the central taxes would be 125, state taxes is 163. Now it goes to manufacturer 2. Manufacturer 2 would have paid 1,288 to procure the goods, but he will still consider only 1,000 as his cost, because he knows for excise duty he can take input tax credit, for VAT also he can take input tax credit. So that is what he would have done. So this 1,000 rupee worth of goods, he will add value to the extent of 200, and he becomes ready to sell the product at 1,200, wherein there will be a hit of excise duty which is 12.5%, and then there is a hit of VAT which is 14.5%. 150 and 196 he pays respectively for excise duty and VAT, and he is ready to sell the product at 1,546. Will he pay this 150 to the government? Will he pay this 196 to the government? No. On this 150, he will utilize the input tax credit of 120 and pay only 25 rupees to the government. Same way, on this 196, he will utilize the input tax credit on VAT of 163 and pay only 33 rupees to the government. So this is what will be done for manufacturer 2. Now for the dealer who's procuring from the manufacturer 2, now this is where it changed the whole complexion. A dealer is not a manufacturer, so he was not eligible for excise duty credit. So instead of treating 1,200 rupees as cost, the dealer would treat 1,350 as his cost. So this element of tax is getting included in the cost. He expects a 10% value addition, 135. He wants to sell the product at 1,485. Yes, he can. And on that, he will have to charge a VAT of 14.5. Fine. So it will reach you and me at 1,700. He wouldn't have paid any central tax. He would have paid only state tax. And that too, 215 minus 196, rounded off to 20 rupees. That is what he would have paid. So in total, if you see, central taxes to the extent of 150 rupees would have gone. State taxes to the extent of 215 would have gone. So the total tax on this item is 365. 1,700 rupees is the selling price, out of which 365 is the tax. This is how it was. Now, once GST was introduced, the whole scenario changed. Manufacturer 1, who was selling it at 1,000, continues to sell at 1,000. The GST, CGST 9%, SGST 9%. What it meant is the selling price is 1,180. Manufacturer 2 treats only 1,000 rupees as his cost because he knows there's 90 rupees and 90 rupees, he can take ITC. Earlier also he was treating only 1,000 rupees as his cost, so there is no change. He adds value to the extent of 200, sells the product at 1,200, he gets 9 and 9, 18%, 108 and 108, 1,416 is the total price. Now, the game-changing moment. The dealer who was earlier procuring from manufacturer 2 was considering as his cost 1,350 because it is including excise duty. Now he is entitled for input tax credit on both the taxes, both the central as well as state taxes. So he must treat only as his cost 1,200 because he is entitled for 108 rupees of CGST and 108 rupees of SGST input tax credit. If he had reduced his prices from 1350 to 1200, then expecting the same profit, the government is not saying the dealer should not make any profit. The trader should make profit, but that is only should not be an undue profit. So on this 1200, he adds value to the extent of 10%. He will be ready to sell the product at 1320 as against the earlier selling price of 1485. There is a remarkable reduction in the selling price, but this is possible only if the dealer passes on the benefit. On this 1320, still GST is applicable. You and me go and buy it. 119 CGST, 119 SGST we pay. The product will reach our hands at 1558 as against earlier 1700. What was 1700 earlier is now only 1558. There is a reduction, or there should have been a reduction of 8.39%. The total taxes have come down from 365 to 238. That is the reason why this reduction has happened. But instead of the tax reduction being passed on to the end customer, if it is blocked by somebody in this value chain, that is where the National Authority for Anti-Profiteering, they will take action against that person. That is why they have been constituted and their term has been extended also. So this is how GST should have ideally benefited all of us. So if there is a problem, the benefit has not come to us, it is not because of GST, it is because of people who are manipulating it. And if you tell me that, sir, you have taken 9 and 9, 18% as a simple tool, what if it is 14 and 14, 18%? And if a product comes under 14 and 14, 28%, still the cost should have been only 1690 to you and me who is buying it in the end customer, which is still lesser than 1700, which was earlier. And the chances of your product going under 28% is very less because there are only 31 items as of today which are under this 28% bracket. So what it tells us is 28% tax bracket is in a way restrictive. Government doesn't want many goods to be under 28 on one hand, and the goods under 28 are the ones which are called as sin goods. They don't want many people to consume it. Hence, only in those cases we will see a marginal reduction, but in all the other cases we will have to see a substantial reduction in the selling price in terms of this 8.39% is the general idea. And this reduction is possible only because of input tax credit. If input tax credit is availed, is utilized properly, this benefit can be passed on to the end customer. So now, with this in context, we will look at how this input tax credit legally functions within the framework of GST. Input tax credit is broadly classified into two categories: input tax credit on goods and input tax credit on services. Input tax credit on goods is further subdivided into input tax credit on goods which are capital goods in nature and input tax credit on goods which are other than capital goods. We call it as inputs. Now the word might be slightly misleading because when we say input, we will expect that to be part of the output. It need not be. As long as it is not a capital goods, but it is mandatory, it is required for the purpose of finishing my output, then it is called as input. It need not be present in the output. When it comes to services, it is further filtered and projected as input services. Any services which is required, mandatory for the purpose of rendering my output, that is what is called as input services. So these are the three common terminologies that we will repeatedly see in our input tax credit discussion. What is capital goods, what is inputs, and what is input services? Because these are the heads for which we can avail ITC, input tax credit. So when we avail an input tax credit, we should be able to tell whether it is for inputs or whether it is for capital goods or whether it is for input services. Now, what is input tax as such? How is it defined in the GST law? Section 2 subsection 62 of the CGST Act is the place where it is defined. And it says, input tax credit in relation to a registered person is the central tax, state tax, that is CGST, SGST, ITST, UTGST, whatever is charged on your inward supply, which you are receiving. Plus, when you are importing goods, you are liable to pay customs duty. As part of customs duty, they will collect a tax called as IGST. Now this IGST, the word and the rate are both derived from GST, but it is not a tax under GST. This IGST on import is technically a customs duty, but that tax paid under customs is allowed as input tax credit in GST. So this is one of the unique credit availment. Generally, we get a GST invoice, we will take input tax credit. But in this situation, when we get a bill of entry, a person gives a bill of entry. That bill of entry is the document with which you are importing the goods into India. That bill of entry, based on that, you can avail input tax credit, because there IGST will be mentioned. And any tax paid under reverse charge, be it CGST, SGST, IGST, that you pay under reverse charge. If my supplier gives me an invoice, I take the credit based on that, that is forward charge. My supplier will give me an invoice, but I have to pay the tax. Then only you can take input tax credit. That is what is called as reverse charge. But categorically, input tax credit can never be availed on any tax paid under composition levy. That means the person who is selling it to me is a person who is opted for composition levy under section 10. First of all, he should not even charge me GST because he is not supposed to. By mistake, he charges 0.5% plus 0.5%. Still, I should not avail input tax credit, because that is a tax paid under composition levy. It is never eligible for ITC. The composition taxable person is the one who can neither avail input tax credit nor pass on the benefit of ITC, because he pays a lesser amount of tax. He pays a very minuscule amount of tax. Hence, he is restricted in terms of availing as well as passing on the ITC. So what is the definition of the word, the three words that we have seen, that is input, capital goods, and input services? Let's go through them one by one. Input, the definition says it is any goods other than capital goods. So the definition doesn't commit anything. They didn't want to commit much. So what they have said is, we will define input, but we will not take pains in defining input. We will simply say it is input is any goods, okay, but it is other than capital goods. So it should not be capitalized. And there are two more conditions. It should be used or it is intended to be used. Either you put it to use or you want to use it in future, or what? By a supplier in the course or furtherance of my business. It is mandatory that it must be used in the course or furtherance of my business. Then only it will be called as an input. Any goods which are other than capital goods, and it should be used or intended to be used by a supplier in the course or furtherance of business. Then they are called as inputs. Now, what is a input service? Any service, there is no restriction, any service, but which is used or intended to be used by a supplier. Again, the same condition. For what purpose? As long as it is used in the course or furtherance of business, it becomes input service. It might be a bit baffling. It might also be opening up the gates. As long as you can prove that this service is required for the purpose of my business, you can avail the input tax credit. They have not said that it is required for the purpose of the output. They have said it is required for the purpose of your business, in the course or furtherance of my business, which is far more reaching and which will give us the scope of availing more input tax credit. Let me give an example. A factory had engaged a company to do landscaping of their garden to make it look good. I'm talking about 2013-14. That time service tax was there. So this company which has done this landscaping for this factory gave them an invoice with the service tax. The factory took the input tax credit on that service tax. It was challenged by the department. It went up to High Court, Madras High Court. The case was fought, and finally Madras High Court had to intervene and give a decision that Only when the factory looks good, people will come. So it is required for the purpose of their factory. But in GST, we don't have to fight like that to get the input tax credit of any housekeeping or gardening, because as long as it is used for your business, because in service tax regime, SENVAT credit rules used to say that it should be directly or indirectly in connection with the production or manufacture or rendering of services. But in GST, it is not about the output, it is about the business. If it is incurred in the course or furtherance of business, the input service, we are entitled to take input tax credit. That is why I said this definition, especially the third part, in the course or furtherance of business, has opened up the scope of availment of input tax credit to a greater extent. Any accountant should be vigilant about this. Only when we know these two definitions, as well as the capital goods definition that we are going to see next, we will be able to identify what is the type of ITC that we are availing. And even before that, we will have to ask a question. Is it a credit? Is it a ITC? Or is it something which is used in the course or furtherance of my business? No, sir, it is not used in the course or furtherance of business. Then there itself you can say it is not eligible for input tax credit. For example, partner of the business buys anything for his personal purposes, but the amount is paid by the company, paid by the partnership firm. You cannot take input tax credit because it is not in the course or furtherance of your business. You cannot avail ITC. The third item under which, or the head under which we can avail ITC, is capital goods. Now, definition of capital goods is the value of which is capitalized in the books of accounts. So an accountant's definition. What is capital goods? Anything that is capitalized. Capitalized means what? Taken to balance sheet, which is not taken to P&L. Value of which is capitalized in the books of accounts, which is used or intended to be used in the course or furtherance of business. So here, again, it is mandatory to prove that the capital goods is used or intended to be used in the course or furtherance of business. Laptops are procured by a company. But today, the laptops are stored. They will not be used immediately. As and when the employees join, they will be given. Can I take input tax credit of those laptops, calling it as capital goods? If you are capitalizing it in the books of accounts, yes. Sir, but it is not used. No, it will be used only when it is allocated to a person. The provision itself says which is used or intended to be used. It need not be used today. It can even be reserved for to be used later. And second, that usage must be in the course or furtherance of business. It must be for the purpose of your business. Then only it can be availed. We came across one funny situation when we are doing fixed assets physical verification. In one of the organizations, when we are doing the physical verification, I wanted to do the major value items first. So lift was the major value item. So I verified 3 lifts were there in the books. We verified and 2 lifts were there in the factory. Then I asked the finance person, where is the 3rd lift? He said, come. He took me in a car. We went for about 20 minutes. And there he stopped the car in front of a house. He took me inside the house and showed the 3rd lift. I was happy that the 3rd lift was there. But I asked him, why is it that the lift which was in the books of the company, it is now here? He said, no, sir, when it was purchased itself, it was installed in the managing director's house only. It has not moved from the factory. Right from day one, it is there in the managing director's house only, which meant that it is not used in the course or furtherance of the business. It is purchased, it is capitalized in the books of accounts of the company. Whether that is right or not, I'm not going into that because that is not GST. That is something which the accountant will have to worry from a Companies Act perspective. But from a GST perspective, you are free to do that, but don't avail input tax credit because it is not used in the course or furtherance of business. So remember this lift. Practically, we have seen that the asset is in the business books, but it is not being used in the course or furtherance of business. Then it is not capital goods. Then you cannot avail input tax credit on procurement of such capital goods. And the credit availment is based on the accounting treatment. If you capitalize, then only it is called capital goods. You don't capitalize, it is not called capital goods. Will people not capitalize laptops? Yes, bigger corporates. You can download the annual accounts of, let's say, Oracle or Microsoft India and check. It will be clearly demonstrated financial policy that they will never capitalize laptops. Even if it is 2 lakh rupee worth, whenever they procure, they will expense it off in the same year. So those companies cannot call laptops or capital goods because for them, laptops are also inputs. They are not losing input tax credit, but they will avail it under the head of inputs. They cannot avail it under the head capital goods. So 3 heads under which we can avail input tax credit. When it is goods, it can either be capital goods or it can be inputs. In case of services, we have to find out whether it is input service. Yes, then we can avail input tax credit. So 3 heads for availing ITC. Moving on. What is the document which makes us eligible to take input tax credit? So Rule 36 is the place where it is defined that one can avail input tax credit based on what documents. There are 5 documents, only 5 documents which are defined in this rule. Any one of this document must be supporting your input tax credit claim. So you tell that, sir, I have purchased for 100 plus 18 rupees. This 18 rupees I'm availing as input tax credit. Fine. That 118 should be supported by any one of this document. Suppose you have procured it from a vendor. The vendor should have given you tax invoice. The tax invoice should contain 100 plus 18. That is one of the documents. That 18 rupees now is validated that it is issued by a vendor. I can avail input tax credit of that 18. 1. 2. Sir, the 100 rupee invoice is given to me, but he didn't pay 18. I paid under reverse charge. I paid the tax under reverse charge. In that case, he is not a registered person. That is, the supplier is not a registered person. So you, as a recipient, would have raised a self-invoice. Remember, we discussed in RCM. Self-invoice would have been raised. Based upon that self-invoice, this recipient can avail input tax credit. The third document which can give rise to input tax credit is a debit note issued by the supplier. Imagine when a supplier issues a debit note, it is to increase the value of supply. When the value of supply increases, the tax also increases. So we are allowed to take input tax credit of that increased tax. The fourth document allowed based upon which we can avail input tax credit is the bill of entry. Just now we discussed how the IGST paid under customs is allowed as input tax credit, and there I told you, how will I prove that I have paid IGST to the customs department, which I want to avail as input tax credit in GST? The government has given a document called as bill of entry. When you clear the goods from customs, they will give you a bill of entry, allowing the goods to enter into India. That bill of entry will contain the tax that has been paid for clearing it from the customs. In that, one of the items will be IGST, for which you can avail input tax credit. And whenever the officer is asking, you can give that as a document. And then finally, an input service distributor, a concept which we will see towards the end of today's discussion. For now, we can assume that there is a corporate office which is getting certain services, but that services are not meant only for the corporate office, it is meant also for other units. But the invoice is on the corporate office. So how does the corporate office give it to others? The corporate office can avail the input tax credit and then distribute it. For doing such activity of availing and then distributing, you cannot be a normal person. You'll have to get registered. And you'll have to get registered in the name of ISD, Input Service Distributor. That kind of corporate office or head office giving an invoice based upon which we avail ITC, that is what is called as ISD. And all the information that is required to be there on an invoice should be there. Only then the invoice is valid. And nowadays, they are insisting, it is mandatory that whatever we see in the invoice, we want to take input tax credit. That invoice should be reflecting in GSTR 2A also. What is GSTR 2A? When my supplier files his return, whatever invoices he has put in his return will come to me. And I'll be able to see who has filed against me. So he says that I have sold to Shankar. So he will upload an invoice against my name. I'll be able to see it in my login. Only if I see it, my credit is valid. If I don't see it, my credit is not valid. Hence, it is mandatory to see it in the GST portal. Then only I can avail input tax credit. Now, this is how the basic eligibility criteria for availing input tax credit has been fixed. Rule 36, read with section 16, is what we have just now seen. Moving on. The other conditions for availing ITC. When I am a registered person, I can avail input tax credit only if I receive the goods or services. In case of goods, it is easy. We can prove that the day it enters into my premises, that is the day of receipt. In some of the cases, I will not receive it in my premises. I will directly send it to my customer also. There, they will not bother about you receiving it or not. They will only ask a question, when did you make it available to your customer? If you had made it available to the customer, then it means that you have received. Then only you can make it available to your customer. So that is considered to be receipt of goods. Same way, services. All these services I can receive. I can take input tax credit. But some of the times, I will ask my vendor to give services to my customer, but I will tell my vendor, bill me. For example, I am purchasing Samsung TV. There is a snag in that, technical problem. It is in warranty. So I will complain to Samsung. Samsung will not send the Samsung people. They will send an authorized person. That authorized person will come and fix the problem. He will not take money from me because it is under warranty. But what he will do is, he will go and raise an invoice on Samsung. Samsung will pay him. It is on their behalf. It is a service rendered to Samsung, but it is not rendered physically to Samsung. It is rendered to me. But who asked it to be rendered? Samsung. So Samsung can take input tax credit on that invoice. This is how goods or services physically should be received by me, but received by others also, I can take input tax credit. And if the goods are received in lots, I have ordered 10 tons of coal, but my customer is supplying 1 ton every day. He started on 27th of October and he finished yesterday. Now, 10 days he has delivered 100 tons or 10 tons, 1 ton each day. Can I avail this input tax credit? The invoice is for 10 tons, one invoice only. Can I avail this input tax credit? Or could I have availed this input tax credit on 27th of October itself? Or I can avail only on 6th of November. It is 6th of November. Because only on the receipt of the last lot, it is deemed that you have received all the goods. Then only at the time we can avail input tax credit. Neither can we say, sir, up to 31st of October, I have received for 5 days. Can I avail for, rather I have received for 4 days. Can I avail proportionate to 4 tons? No. Only on the receipt of last lot, the whole ITC should be availed. The other conditions are, whatever is the tax that is charged in the invoice by my supplier, he should have actually paid it to the government. He should have paid it to the government. He has charged in the invoice, so I will take ITC. But whatever I am taking it as ITC should have actually reached the government. He should have paid the tax to the government. That is an expectation from the government. How will I be able to ensure that whether he has paid the tax or not? As of now, there is no procedure. I cannot, unless I go and sit with him while he is filing return to find out whether he is paying the tax or not. I cannot find out whether he has paid the tax, but it will appear. The invoice will appear in GSTR 2A. So if he uploads the invoice, it will appear in my 2A. That can give me a reasonable amount of confidence that this gentleman is going to deposit tax on this invoice. So that is the way in which we are now satisfying this condition. But strictly, that is not the foolproof mechanism. Moving ahead. The other conditions for availing input tax credit. You should have filed a return. Only when you are furnishing a return, you are entitled to avail input tax credit. So, if you do not file a return, no ITC. Because only when you file a return, you tell the department that you become entitled or you are availing this much of input tax credit. If you do not tell them, then how will they know? Hence, only when you file a return, you are entitled to avail input tax credit. Taking a simple example, tax liability for a month is 50 lakhs. For a month is 50 lakhs. And the input tax credit availed during the month is 30 lakhs. I have not paid the remaining 20 lakhs on time. I should have paid by cash the remaining 20 lakhs. So the question is, should I pay interest? Yes, because I have delayed the payment. But should I pay interest on 50 lakhs or 20 lakhs or 30 lakhs or none of the above? Because 50 lakhs is gross, 30 lakhs is the ITC, 20 lakhs is the net difference. Or none of the above, maybe I could be wrong. For this only, it was a fight which was happening for quite some time between the department and the assessees, wherein it has now reached a reasonable finality and amendments are going to happen maybe in the next budget in February 2021. What we are expecting and what has been indicated is that you don't have to pay interest on the ITC portion. I'm liable to pay 50, but I have ITC of 30. So what I need to pay to the government by cash ledger is only 20 lakhs. So I need to pay interest only on 20 lakhs. But before this clarification or clarity had emerged, department themselves, as per law, were demanding interest on 50 lakhs, which is no more relevant. And then the very important condition which comes under the input tax credit mechanism, which is very important from a GST angle as well as a working capital angle as well as MSME angle, is that within 180 days from the date of invoice, within 180 days from the date of invoice, the tax must be paid. Rather, I should pay to my supplier both the basic value plus tax. My supplier raises an invoice on me, 100 rupees plus tax. I should pay him 100 rupees plus tax within 180 days. If I do not pay him within 180 days, then that 18 rupees of credit which I availed, I will have to reverse. I become disentitled for it. Why am I disentitled? Because you are utilizing or enjoying a credit for which you are not entitled. Okay, I have reversed it. But subsequently, I made the payment. Let's take an example. January 1st, 2020, I got an invoice. I did not make the payment till 30th June 2020. So for 6 months, I have not made payment to him. 180 days is over. So what am I supposed to do? The ITC that I availed in January for that invoice, I should reverse in the return for the month of June. Now, after COVID period is over, in say November, we are coming to a conclusion. Okay, fine, I'll make you payment. Maybe I will make him the full payment or I'll make him 70% payment. Let us assume the first situation. I'm making him the full payment. Then what can I do? I can avail the full input tax credit. That is, in June return, I would have reversed the ITC because legally, I did not make the payment within 180 days from the date of his invoice. So I am not allowed to enjoy the credit, which I given back. Now, when I am making the payment now, I am entitled to take that input tax credit. That is what is the beauty of this provision in section 16, read with rule 37 on one side. Second, I am not paying him 100%, sir. I am paying him only 70%. We come to a conclusion, one-time settlement. I'll pay only 70%. Fine. In that case, you would have reversed the full ITC in June return. Whatever is the ITC pertaining to 70%, you can avail. The ITC that is pertaining to this 70%, you can avail as input tax credit. Then you make the payment. So this aspect is called recredit. I availed the credit in January 2020. I reversed the credit in the month of June's return, June 2020's return, because I did not make the payment within 180 days. But when I subsequently make the payment, it could be any time subsequent. It could even be 10 years later. But whenever I make a payment, proportionate to that payment which is made, I cannot get full credit. Neither am I denied full credit. Proportionate to the payment whatever I have made, I can take the input tax credit. That is what is the recredit provision in Rule 37, read with Section 16. Now, the next part is again an accountant's domain, where the accountants will have to be vigilant. Whenever I am procuring an asset, I have only two options in front of me. Let me give an example. Look at this example. An asset is purchased for 1 crore rupees. On the procurement of the asset for 1 crore, I have paid a GST of 28 lakhs. So 1 crore plus 28 lakhs. I am capitalizing this asset in my books at 1.28 crores. I am creating the asset at 1.28 crores. Question is, can I avail input tax credit? Answer is no. Because when you have availed the GST also as part of the capital value of the asset. So now the balance in the asset stands at 1.28 crores, which makes you eligible to claim depreciation on 1.28 crores. Depreciation under Income Tax Act, Section 32 of Income Tax Act. When you are claiming depreciation under Section 32 of Income Tax Act on 1.28 crores, why would the government give you one more time the benefit of 28 lakhs by way of ITC? So you have two options in front of you. Capitalize the asset at 1 crore, avail 28 lakhs of ITC. Or capitalize the asset at 1.28 crores, don't worry about ITC, you will not get it. That is what is the restriction in Section 16. Either you can capitalize the GST portion, claim depreciation, no ITC. Or you don't capitalize the GST portion. We are not talking about 1 crore. We are discussing about 28 lakhs only. 1 crore is anyway capital value. There's 28 lakhs of GST. Should I capitalize? Should I not capitalize? You want ITC, don't capitalize. You don't want ITC, capitalize. Claim depreciation. Dual benefit will not be given. Only one benefit will be given. Either depreciation or ITC on this capital goods GST portion. And the last condition before we break for 10 or 15 minutes is the time limit for a person to avail input tax credit. What is the time limit? There are two dates that are being spoken about in this Section 16, whichever is earlier of the two. The first date is the due date for filing the return for the month of September of the following financial year. Due date of filing of return for the month of September of the following financial year, or the date of furnishing of annual return. Now look at the difference. The first one is due date, the second one is date. Generally, let us take an example for financial year 1920. Financial year 1920. The date of furnishing for annual return, maybe I have furnished the annual return. I'm going to furnish the annual return on 30th November 2020. But the due date for filing of return for the month of September following the financial year. The financial year got over on 31st March 2020. So the September that is following the end of the financial year is September 2020. What is the due date for filing of return for the month of September 2020? That is 20th of October. So for an invoice which is dated, in the financial year 1920, I can avail input tax credit. For invoice which is dated in the financial year 1920, I can avail input tax credit anytime before 20th of October 2020 or 30th of November 2020, whichever is earlier. Because the due date of filing of return for the month of September. Why they have kept it as due date is I can purposefully delay the filing. So even if you delay the filing, you're not going to get benefited because it is not date of filing of return for the month of September. It is due date of filing of return for the month of September. Whereas on the other hand, for annual return, they have kept it open. It is the date of filing of annual return. Sometimes, since you have finished the accounts, you will file the annual return earlier also. You will file the annual return a step earlier. Meaning, September's due date is 20th of October. Maybe you go and file the annual return on 16th of August itself. In those cases, you cannot avail input tax credit after 16th of August for the previous financial year because it is earlier of these 2 dates. I'll repeat one more time. The due date of filing of return for the month of September of the following financial year or the date of furnishing of annual return, whichever is earlier, is the date by which ITC has to be availed for a document pertaining to a financial year. That financial year, this is the time limit. Next financial year, same time limit will shift. So be very clear about this time limit because some people say it is 6 months, 12 months. No, there is no 6 months, there is no 12 months. Suppose April 2019 invoice, it is 18 months now because April 2019 to September 2020. But for March 2020 invoice, it is only 6 months. So nobody can say 6 months, 12 months, 8 months, 9 months, nothing. It is the due date of filing of return for the month of September of the following financial year or the date of furnishing of annual return for that year, whichever is earlier. That is the time limit within which one has to avail this input tax credit. Now, we will have to look at the restricted or blocked input tax credit under section 17. What I would suggest is let us take a break now for about 10 minutes and then we will resume with the discussion on section 17.
Dear participants, have a break for 15 minutes and please join us back by 4 p.m. Excuse me, sir. Excuse me, sir.
Can we commence?
Yes, sir. Yes, sir. We can commence.
We have few questions, I guess. We'll finish that and then I think we'll get back to blocked credit. Sir, buying mobile phone for business, considering as a fixed asset, can we take credit? Absolutely, yes. There is no restriction on that. But I'll tell you where you will have a hitch later when we discuss section 18. Sir, I have a question regarding overseas payment. If I sell my service to overseas party and I have to raise sales invoice to them, and that sales invoice can we send for filing GSTR1? You have to. See, you are the supplier, so you have to report it. If any provision in GST for this kind of transaction, this is called as zero rated supply, or in other words, it is called as export of service. You are allowed to do the transaction and you must disclose it in your GST return. In GSTR1, there is a table called table 6A. That is where it needs to be reported. And September return is not filed, but the dealer files annual return. Can he avail ITC? Sir, September return is subsequent financial year. Before that, can he file annual return? Yes, he can. The only condition for annual return is for which year you are filing annual return, you should have filed all the returns in that year. So yes, there is no restriction or there is no problem. You can still file the annual return. But can you avail the ITC in the annual return? I don't think so. You cannot avail it in the annual return. You should have availed it before filing the annual return, which must be your monthly return. Any month before filing the annual return, you could have availed the credit. Yeah, those were the questions. I think now we will get back to our presentation on the blocked input tax credit or restricted. Now, what we have seen so far is the credits which are allowed or the eligibility conditions for which I can avail the input tax credit. When I satisfy this eligibility condition, it is obvious that I can avail the input tax credit. But there are certain credits which the government doesn't want us to avail and enjoy completely. So they are going to put a restriction on us. What are those for which they have put a restriction? Because instead of telling all these are eligible, because they have just opened up by saying anything used or intended to be used in the course or furtherance of business, you are entitled for ITC. So that is a broader spectrum. Instead of defining what is there in the universal set, they have gone by the set theory mechanism called as A dash. I will tell you for what you cannot avail, which means everything other than this you can avail. So the restriction is smaller and restriction is defined. Blocked or restricted credits. So situations are defined in section 17. When anything is used partly for business and partly for other purposes, it could be input services, capital goods. Only to the extent of business purpose utilization, one can avail ITC, not for non-business purpose. Example, in income tax, we used to do that. The building is used both for accommodation for the residents as well as the business. The depreciation, when they will claim only part of the depreciation, that is half of the depreciation, saying that half of it is residential and half of it is used for business. Then, same way, whatever the assets that are there, common, the credit is also something which you should avail only proportionately. You cannot take it fully. Only what is pertaining to the business purpose should be availed. And if I am using the input and input services, both for exempted activities as well as taxable activities, I have outputs which are exempted and I also have outputs which are taxable. In those cases, I can avail input tax credit only to the extent of my taxable outputs. I'll just give an example of how this can work. Now imagine I am a milk dairy. I am into manufacturing packet milk. But that is not all. I am also manufacturing paneer. Because milk is the basic product. I am processing and selling a part of it as milk. And apart from the one which is packed, the remaining milk, I am further processing it and converting it to paneer. And some amount of the milk, I convert it into ice creams. This is my business. Now, the point that I want to drive home is my milk business is exempt. My paneer business is taxable. My ice cream business is also taxable. My outputs are 3, out of which one is taxable, or rather 2 are taxable, one is exempted. So can I take input tax credit for this business? You can take, but you can take only to the extent of the exempted activities, rather only to the extent of the taxable activities. You cannot take to the extent of the exempted activities. You can avail ITC only to the extent of taxable activities, not to the extent of exempted activities. So how do I find that? How do I segregate and do that? For that purpose only, section 17 subsection 2, 17 subsection 3, read with rule 42 and 43. What it has said is, okay, now we will go through a filtration process. Your total ITC in respect of input and input services, please take it. And from that, remove the credit which is pertaining to other than business purpose. Remove it because it is anyway not eligible. Okay, removed. And then those credits which are specifically restricted or blocked by the government, remove it. Done. Now what you are left with is credits which are available for you. But that credit, further split it into 2 parts. A credit which is specific, and we don't have to tell what is the other part. When you can find out whether it is specific to a business, the remaining is other credits. So if a credit which is specific to a taxable business, then avail full credit. The credit is specific to an exempted business, do not avail the full credit. I'll give an example. The packing material purchased for milk, the polythene which I am procuring, I have to pay GST. But can I take input tax credit? No, because it is a specific credit, but that credit is specific to an exempted output, the output being milk. So it will come here. I cannot take full input tax credit, 0 on that invoice. Whereas the packing material that I am procuring for ice cream packing or paneer packing, is specific to taxable, I can avail full input tax credit. So it can come under specific to taxable. Same way, if I cannot identify a particular credit as specific, then what is it? It is generic, other credits. Example, audit fee. Being an auditor of that company, I would have audited all the income. So my service cannot be designated as only pertaining to exempted or only pertaining to taxable. It is generic. So for all those credits which cannot be identified as specific, so we have gone through a filtering process. Take the total ITC of input and input services. From that, remove the non-business related credit, and out of the balance, remove the blocked input tax credit. Now the remaining balance is available credit. In that, drill down and find out what is specific credit. Specific to taxable, specific to exempted. And what is specific to taxable is fully eligible. What is specific to exempted is fully not eligible. And we have other credits, that is, which is not specific, but which is eligible, that we will not get the full credit. Rule 42 says you avail it proportionately. Proportionate to what? Proportionate to your taxable turnover. Taxable turnover divided by total turnover will give you a proportion, multiplied by common credit. To that extent only you avail. Same way, exempted turnover divided by total turnover multiplied by common credit. To that extent you don't avail. So this is the structure of common ITC availment. A very, very important aspect. Again, an accountant's forte. You have to understand the logic, because if one tries to go through Rule 42, we will be encountering algebra there. It will talk about T1, T2, T3, T4, C1, C2, D1, D2. All that will be there. We'll be wondering what are we doing? E by F into T1, T2, T3. This is the logical understanding. Why this is logical? Because this is how they have envisaged the provision. They want you to take credit for that business which is taxable, and they don't want you to take credit for that business which is exempted. So when I can identify it specifically, do it accordingly. When I cannot identify, that is when I will apply proportion. So we have to be careful. The proportion should be applied here and not here. That is, the proportion should be applied at this juncture and not here. Because if you apply the proportion here, you are doing a mistake. You are over reversing or under reversing. Hence, please be aware of the step-by-step elimination process. This is outlined in Rule 42. Sir, but if capital goods is common, because in a milk dairy, the milk processing machine is the first step. That milk processing machine processes all the milk. It doesn't know whether the milk is going to be sold as milk itself, or it is going to be further processed into paneer or further processed into ice cream. I do not know. But milk processing is a common process. So here, the milk processing machine is a common capital goods. For that, this is the method suggested in Rule 43. The government has given a thumb rule that every asset that you are procuring, deem that that asset is valid only for 5 years. That is 60 months. So take the input tax credit, but every month take 1 by 60. What is the significance of this 1 by 60? 1 month's credit out of 60 months, which is meant for 5 years. Take 1 month equivalent, multiply that by exempted turnover divided by total turnover. So you will get a proportion. Exempted turnover this month is 40, total turnover is 100. Then common credit, that is the 1 by 60 of the capital goods credit multiplied by 40 by 100 will give 40% amount of the common of the capital goods related ITC. That will become ineligible. To that extent, you will have to reverse. So why should I reverse? Because you have already availed the full input tax credit when you procure the capital goods. So every month, this calculation will have to be done for those assets, those capital goods which are common. Common for what? Common both for exempted as well as taxable activity. So this is a very, very important step of input and input services being common for both the outputs, capital goods being common for both the type of outputs, how to do the reversal. Rule 42 and 43, an aspect that accountants must be aware. And then the business specific provision. The business specific provision is pertain to this industry, which is the banking and financial services industry. The banking and financial services industry, imagine this kind of reversal is being prescribed. The majority of their income is interest income, and interest income per se is exempted. So for that exempted income, if they start calculating this kind of reversal, when will they complete? So what the government has said is, for all the banks and financial institutions, we are giving you an option. Option 1, go for this reversal method, which is what we just saw, which I don't think anybody will prefer because too much of work. Our second option is very simple. Avail only 50% of your ITC, eligible ITC. So what they will do, they will take an invoice, they will see how much they are eligible for. If it is 100 rupees they are eligible for as input tax credit, they should take only 50. They should not take 100. This has been simply given for the banks and financial institutions, which is logical. And that is what every bank or financial institution that I have seen have all grabbed this as an opportunity. Imagine a bank branch having a lot of services, the statutory audit service, concurrent audit service, the rental for the branch, rental for the ATM, security services. All this, when will they sit and do this segregation as to how much is pertaining to exempted, how much is pertaining to taxable? Instead, if they feel that that credit is eligible and there is no restriction, they can take, but they will take only 50%. That's it. Becomes easier. This provision was there in the erstwhile CENVAT credit also, but it was not there from day one. It was introduced only from 1st of April 2016, and promptly it has been taken into GST also. Now, the next part of blocked input tax credit, specifically blocked credits. Any credit pertaining to motor vehicles. Motor vehicles or other conveyances. So they are very clear. If you say the word motor vehicle, then people will say only when it has a registration number, it is called motor vehicle at all. So they have clearly said motor vehicle and other conveyances, including the battery operated, everything will come there. Where it is meant for transportation of persons having passenger transportation, it is restricted, but the restriction of credit is going to apply when the seating capacity is not more than 13% only. So the restricted credit, or the credit that should not be availed in respect of a motor vehicle or other conveyances, if the seating capacity is not more than 13%. This gives two kinds of clarity. One, goods related vehicle, there is no restriction at all, because there is no seating capacity measurement there. And when it comes to passenger vehicle, if the passenger vehicle has seating capacity exceeding 13, including the driver, 13% more than 13% is seating capacity, let's say 14, excluding the driver, then there is no need for me to bother. I can take the ITC because the restriction is only up to 13. And there also, what they have said is, if the motor vehicle has a seating capacity only up to 13, still you can avail input tax credit in 3 scenarios. Let's take the example of a car. The biggest car you can imagine on the road is Innova, which has about 7 seating capacity. That's it. So it is coming under 13 for sure. Any small car, 4% seating capacity, Maruti, Hyundai, 4% seating capacity. What this provision says is that if it is not coming under 13%, it is not more than 13% seating capacity, less than 13% seating capacity, no problem. You can still take ITC provided you are in the business of further supply of that motor vehicle. I am a car dealer. I buy and sell cars. Why can't I take input tax credit of the car that I purchase? Yes, you can take input tax credit of the cars that you purchase. Department allows you by this exception. And second situation, when I use this car for transportation of passengers, my main business is to use the car for transporting passengers, then even though it is lesser than 13% seating capacity, I can avail input tax credit. And finally, I am using this vehicle for imparting driving skills, for imparting driving training of motor vehicle, that skills, then I'm entitled to avail input tax credit. So Less than 13% seating capacity, no, is the first level of answer. But less than 13% seating capacity also, yes, if any one of the three situations is attracted. When it comes to goods, there is no restriction. So any vehicle which is used for carrying of goods, how much soever small or how much soever big, you are entitled to avail input tax credit. The other ITC or expenditure which is associated with motor vehicle is the running expenses, the general insurance, servicing, repairs and maintenance. If you own the vehicle, you will have to incur these expenses, insurance, servicing and repairs and maintenance. If the vehicle is eligible for you, the vehicle comes under the category of eligibility, then the insurance, service, repairs and maintenance is also eligible for input tax credit. If the vehicle is eligible, the associated credit is also eligible. And if you are going to lease the vehicle, leasing, renting or hiring of motor vehicles or vessels or aircraft, in those cases, leasing, renting or hiring of motor vehicles or vessels, in those cases also, even though it is not belonging to you, but had it been your vehicle, your vessel or aircraft, would you have been eligible for ITC is the question. If the answer is yes, then for renting, leasing or hiring also, you can avail ITC. How does it operate? I'm not buying a bus. I'm hiring a bus for transporting my employees. I can avail ITC because it is more than 13% seating capacity. Had I purchased that asset, ITC would have been there. Instead of buying, I'm taking it on rent. I'm eligible to avail the ITC. So the day-to-day running expenditure, repairs and maintenance on one side, the leasing, renting or hiring on the other side, all becomes eligible for input tax credit. Now, the other blocked input tax credit, any kind of food and beverage, outdoor catering, beauty treatment, health services and cosmetic surgery. All this are treated in one pedestal and we are not entitled for input tax credit on these. But of course, with an exception. If any of these services are received for the purpose of providing a service of similar nature, I am receiving these services for providing service of similar nature, then I can avail input tax credit. I am a hotel. I buy food and I sell food. Why would a hotel buy food? Maybe they are not buying regular food, they are buying some specialized item. That specialized item they procure, the person who's selling it to them charges them GST, and when they are selling it as part of their food, they charge GST, they are entitled to take input tax credit. So food, we cannot always say no ITC. Second example, this training is happening over internet. Suppose this training is happening face to face, where you have paid a fee and it is happening in a hotel. Lunch is also included in the fee. That fee is taxable under GST. That fee includes food and education. So this food, which the hotel gives to the person who is organizing, the person who is organizing can take ITC of that food item because he is not consuming it. He is using it for further supply. He is not supplying food, but he is supplying food also. It is part of his mixed or composite supply, whichever way you want to call it. Same applies for beauty treatment, health service or cosmetic surgery. If it is part of it, you are receiving it and rendering it to somebody as part of your output service, then you are entitled. Else, you are receiving it and consuming it, you are never eligible for input tax credit, especially cosmetic surgeries, beauty treatment and health services. In case of all the cinema stars and models, they would do cosmetic surgeries, high costly items, and then they would use gyms, healthcare services. In all this, there will be a GST charge, but they can never avail input tax credit because they are not supplying this as output. They are utilizing this and then supplying their service. So there is no ITC on all those. Membership of a health club, health and fitness center, given to managing director, given to employees, in any of the situations, no ITC. Specifically blocked input tax credit. Travel benefits given to employees, leave travel concession, no. But if they are traveling on duty, it is for the purpose of business, eligible. Other than business, not eligible. And then works contract service. Works contract is any kind of construction, erection, commissioning, installation, fitting out, repair or maintenance in relation to an immovable property. If I am doing it, generally no ITC, but two situations ITC will be allowed. One, when that works contract is in respect of a plant and machinery, it is used for a plant and machinery, or when I am a works contractor myself and I am rendering services to another works contractor. Chennai Metro has given me a contract. I am L&T and I have given it to Mr. X. Mr. X is a works contractor who will bill to L&T. So Mr. X can take input tax credit and he is billing it to L&T. L&T can take input tax credit. But L&T gives an invoice to Chennai Metro. Chennai Metro cannot take input tax credit because Chennai Metro is not a works contractor. So if I am a works contractor who is receiving works contract service, I can avail ITC. Either it should result in a plant and machinery. I am employing an engineer. He is doing works contract service. The works contract service is resulting in a plant and machinery. It is not resulting in a building. It should result in a plant and machinery. Erection, commissioning, installation, fitting out, repairs of a major machine. Then, even on his works contract service, I can avail ITC. So, plant and machinery includes anything fixed to earth, but does not include land, buildings, and civil structure. They will never be considered as plant and machinery. Telecom towers, no. Pipelines, which are laid outside the factory, will also not form part of plant and machinery. So all the telephone companies, especially the landline companies, the internet broadband companies, will get hit by this. Neither their telecom tower is called as plant and machinery. The wires or pipelines which they lay outside their premises, they have to lay everything only outside the premises. No, that is also not entitled for calling it as plant and machinery. Maybe in income tax you can call it as plant and machinery, not in GST. Hence, not eligible for input tax credit. The next service, similar to works contract but slightly different, is construction of immovable property service. When you are constructing an immovable property, no input tax credit, but you can avail when it is used for plant and machinery. You can avail it when it is used for plant and machinery. You are constructing and the construction results in a plant and machinery, you can avail ITC. In any other situation, you cannot avail ITC on construction service. And what is construction? Construction includes renovation, reconstruction, additions, alteration, or repairs, but to the extent of capitalization. If you don't capitalize, you are taking it to P&L, then there is no issue. To the extent of capitalization, that is what is called as construction. So this is the other element of blocked credit specific to construction service, construction works contract. Adjacent definitions, but eligibility is very, very cautiously to be understood. Not open for all. The other blocked credits are goods which are lost, stolen, destroyed. What is lost? What is stolen? How are they different? Lost is pilferage. I will not give a police complaint for that. Maybe I had 1,000 units, 2 are missing. I will not give police complaint because I know it's pilferage. Maybe that's a screw, that's a nut, or a particular part item. But what is stolen? Clearly, I will give a police complaint. I'll pursue with insurance company also. That is what is stolen. Destroyed, either man-made disaster or natural disaster, it is destroyed. I cannot use it any further. Those goods. And the goods which we write off. Again, a word only a accountant can understand. What is written off? We will only do it. We will write it off from the books of accounts. If you are writing it off from the books of account, then in those cases, you should not avail the input tax credit. When I purchased the goods, I availed ITC, sir, but subsequently it got stolen, it got lost, or it got destroyed, or it was written off from the books of accounts. Then whatever ITC that you had availed becomes blocked credit. You should give it back to the department. Or when you are giving it away by way of gift or free samples. When I am getting a item, especially during Diwali, let's say the company is buying sweets and it is distributing to all their vendors and employees and dealers. They can do that freely, but the goods are disposed of by way of gift or free samples without collecting any money. Then the blocked credit, that is, when I procured it, I would have paid GST. That credit becomes blocked credit. I cannot avail it. If I had availed it, I have to give it back. So that is what is the second part of this 17 subsection 5 clause H restriction. Goods lost, stolen, destroyed or written off, or goods which are disposed of by way of gift or free samples. Now we move into the next aspect, which is the unique provisions with which one will be able to avail input tax credit. What we have seen so far is the blocked input tax credit under section 17. What I can do now is see whether any questions are being posted for this. Yeah. Instead of ITC, if we charge depreciation, can we charge P&L account with full depreciation? Yes. P&L account with full depreciation meaning whatever is the rate of depreciation applicable for that asset, that only you are going to apply on the total value. We saw an example of 1.28 crores. Let's say if it is a 20% depreciable item. On 1 crore, you would have applied 20%. Instead, now you are going to apply it on 1 crore and 28 lakhs. That's all. That doesn't mean 28 lakhs you will be able to take it to P&L. No. Total capitalization is 1.28 crores. On that, you will be claiming depreciation. That is how it will work. Okay. I don't see any other question. So I think we can. Continue with section 18 discussion. Now, section 18 as I said earlier, has got a different reason. So far, I was an unregistered person or a person coming under composition scheme or whatever goods I was dealing with was all exempted. We are looking at a person who was unregistered so far, let's say till today, till 7th of November, he was unregistered or he was under composition scheme or the goods that he was dealing with were all exempted. But suddenly something has happened today that he has come under the tax net. He has become registered or he has moved out of composition or his goods which were exempted have now become taxable. In this case, what is he supposed to do? Now he becomes a nominally registered person. What the government says is, don't worry. Now, when you were here as unregistered and you are moving to the registration criteria, on the day, on this cutoff day, which is 7th of November, whatever was your opening stock, whatever was your opening stock of inputs, please find out from the invoices whether on those purchases. If you had paid GST on those purchases, section 18 provision allows you to take input tax credit of those invoices. It allows you to avail the ITC on those invoices. Because those goods which are lying in your stock on 7th morning are the ones which you are going to sell from that day. So now from that day you are a registered person. From that day whatever you are selling you are liable to pay GST. Now when I am on one hand making you liable to pay GST, on the other hand I have the responsibility to tell you that you are entitled for ITC. But if you had already procured the item, that time you are not registered or you are not eligible because you are a composition taxable person or you were dealing in exempted items, but suddenly scenario has changed. So I should give you a chance to avail the ITC. That is what this section 18 subsection 1 says, and it is a credit which is to be availed by filing a form called as ITC 01 by this person who was so far not liable, now becoming liable, can avail the input tax credit on the opening stock on that day. Now we are going to see a reverse scenario. So far I have a person who is continuing as a normally registered person. And what is happening is, from being a normally registered person, it so happens that I don't intend to continue as a registered person any further. So I just move out, or I opt for composition scheme, or the product that I am dealing with becomes exempted. As I said, this is a reverse scenario. In this case, what should I do? Whatever is the closing stock that you have on the day, you become the unregistered or composition or exempted. When you are getting out of normal registration, whatever is those items with which you are moving out, on those items, whatever ITC you had availed earlier, you should give it back to the department by way of reversing the input tax credit. I hope is it clear. So one, you availed the ITC. Two, you are going to give it back to the department, the input tax credit. In the first situation, you are coming into GST. In the second situation, you are going GST. The next scenario, this is what I told you at that time when telephone, or rather the mobile phone question had come. When I am selling any capital goods, when I am a person who is disposing of capital goods, what am I supposed to do? Section 18 subsection 6 says that whenever you are disposing of capital goods, you are supposed to do two calculations, being calculate the ineligible input tax credit. What or how do I say I am ineligible for something? For that, they have given a solution. Go and find out and how many quarters this asset has been put to use. How many quarters you have retained the asset with you. For every quarter or part of a quarter for which you have retained this asset with you, you are entitled for 5% of the original input tax credit. You are entitled for 5% of the original input tax credit. Whatever is the number of quarters for which you have used it. Let us take numerically. I have purchased a mobile phone, any costly mobile phone for 1 lakh rupee on 1st of January 2019. That mobile phone, 1 lakh rupee plus GST of 18,000. I have procured it. I have taken ITC. Now, today I am selling it. Nobody generally uses who can afford that much of costly mobile phone doesn't use it for more than a year. In this case, I'm assuming that this person has used it for 1 year and 11 months. Now, how many quarters have I used this mobile phone? I have used it for 4 quarters in the year 2019, and I've used it for 4 quarters in 2020. So how can you say 4 quarters? Today is only 7th of November. The quarter ending 31st of March is 1 for 2020. 30th of June is 2. 30th of September is 3. Add to that part of this quarter. 7th November is part of the 4th quarter. That should also form part of your 5% calculation. So effectively, 8 quarters it has been put to use. 8 into 5%, 40%. 8 quarters into 5% per quarter takes it to 40%. We are entitled only for 40% of the ITC that was availed. How much did I avail? 18,000. 40% of 18,000. Okay, that would come to 7,200. I am eligible only for 7,200 rupees of the ITC. Oh, I availed 18. So 18 minus 7,200 becomes 10,800. I am ineligible for 10,800. Yes. But does it mean I have to reverse? No, hold on. Now calculate the second amount. The second amount is, what is the price at which you are selling it? Now, certainly we all know a mobile phone which is 2 years old can never fetch, what was though purchased for 1 lakh, can never fetch more than 10,000. Let us give a lenient view, 20,000. Even if you say 20,000, how much is the GST on it today? 18%. 3,600. So now we have two amounts in comparison. The ineligible ITC, which is 10,800, the tax on the selling price, which is 3,600, which is higher. Obviously, the ineligible ITC of 10,800 is higher, you are liable to pay GST of this 10,800. I'll repeat, you are liable to pay GST of this 10,800. Sir, but I'm selling it only for 20. It doesn't matter. Even if you sell for 20,000, you have to pay 10,800 rupees GST because of this capital goods. So then every capital goods disposal, this problem will come? No. Any capital goods which you are disposing it of after 20 quarters. Why 20 quarters? For every quarter you are entitled for 5%. So 20 quarters would mean 20 into 5, 100%. So if you had used the asset for 20 quarters, in other words, 5 years. 4 quarters makes 1 year. So 20 quarters is 5 years. If you dispose of the asset after 5 quarters, you don't have to worry at all, because the first calculation will become zero always. That is the intention of the government. They want you to use the asset for more than 5 years. But these electronic items, especially mobile phones and laptops, not many of us use it for more than 5 years. In all those cases, if you had treated it as capital goods and you had decided to avail the ITC, get ready. You'll have to do this calculation on their disposal. You'll have to do this calculation on the disposal. So it is better to assess at the first stage itself. That should I take input tax credit on this capital goods, or should I refrain from taking ITC? Because in case of such electronic items, it is better to stay away rather than take the credit and get into the problem of reversal at a later point of time. Not even take it, capitalize it and claim depreciation if you know very well that you are not going to use it for 5 years. So this is where the catch will come. In case of capital goods, as an accountant, we have to be clear in this 5-year rule. Though it is not said anywhere, it is an interpretation, which is what is knowledge we'll have to carry and say, 5 years, if you say that I'm going to use it, then avail ITC. If there is a doubt that you may not use it for 5 years, better to claim depreciation, because anyway you're not going to lose anything. If you claim more depreciation, profit will come down. Because profit comes down, income tax will come down. So there is no loss for you. Hence, 18 subsection 6 has to be interpreted in that manner. Now, the next aspect, section 19 of the CGST Act, which talks about job work related provision. What is job work? Job work is to do something on the goods which belong to another person. Any treatment or any process which is done on the goods which belong to another registered person, that is what is called as job work. And that job work, the goods which belong to the other person, which I do, is considered as a service. The goods belong to you. I do something on it. It is job work. In doing that something, I may add some material also. Doesn't matter. It is still considered as job work only. Sir, I added material. Can I call it as goods? No. It is the basic goods belonging to that person. On that you are doing this. It is considered to be paper is supplied by a customer, and he also gives the matter. I just type it or I print it and give it to him. What I am doing is only a job work service. Why? The goods belong to him, paper, but ink is belonging to me. Correct, but ink is part of your service. So it is considered to be a job work. Now this job work and ITC has got a close connection. People will send their goods outside to a job worker, because job worker will not be here. Job worker will be elsewhere. He will process it and give it back. When I am sending it to a job worker, government always has an apprehension that in the name of job worker, these people will sell it to a customer. So they have put a restriction. You can send goods to job worker, but tell me whether it is input or capital goods. If you are sending inputs to the job worker, the inputs must come back within 1 year. If you are sending inputs to a job worker, the inputs must come back within 1 year. If you are sending capital goods to a job worker, then it must come back within 3 years. So in case of capital goods, a slightly longer duration is afforded. If it is inputs, it has to come back within 1 year. If it is going to be capital goods, it has to come back within 3 years. And this time limit, by recent amendment, they have said that the commissioner of the jurisdiction has the power to extend the time. That is, he can extend this 1 year by another 1 year, or this 3 years by another 2 years, depending upon the need of the assessee. It is not automatic. The assessee will have to request the commissioner for such extension. And this time limit of 1 year or 3 years is not applicable in case of molds, dies, jigs, fixtures, and tools. This time limit of 1 year or 2 years is not applicable for mold, dies, jigs, fixtures, or tools, because these are low value items as well as the ones which may not sustain for a longer duration. Hence, taking that into account, the government has given a lenient view that molds, dies, jigs, or fixtures, or tools, this time limit is not applicable, which means they can even perpetually stay with my job worker. Still, there is no problem. But anything other than that, if it is going to go to my job worker, it has to come back within 1 year. It doesn't come back within 1 year, you have to pay GST. Capital goods sent to a job worker has to come back within 3 years. It doesn't come back, you have to pay GST. And it is even more painful because you have to treat it as a tax that is payable from the day on which it was sent. So after 3 years, that is the pain that one has to go through if job working procedures are not complied from a point of view of ITC. And then the goods, when they are sent to a job worker, they must be sent under the cover of a challan. What is a challan? That is a document, the delivery challan, with which the goods move, because I am not supplying it to my job worker, so I cannot raise a tax invoice. I got to raise a delivery challan, which is in the nature of job work challan, and it should come back also. Whatever I send, it should come back, and all the data of such delivery challan, outward and receipt inward, I should file in a form called as ITC 04. This statement should be filed on a quarterly basis, which is meant for all those people who are utilizing the services of job workers. And the last part of our discussion today, an input service distributor. Who's an input service distributor? As I said earlier, the head office or the corporate office will have services being received. It is not applicable for goods. As the name suggests, it is input service distributor. So they will receive the input tax credit. What will they do with the input tax credit? They have it common. That credit which they receive is common for everybody in the organization. So what they can do is they can distribute it. How they can distribute? They can distribute the central tax received by them as central tax or IGST, or state tax by them as IGST or SGST. They have that power. But what is the proportion in which they have the right to distribute? They have the right to distribute based upon the turnover. Turnover of what? Turnover of the previous year. Turnover of the previous year of that unit. For example, I have a head office in Chennai. I have 3 units across India. One in Chennai, one in Andhra Pradesh, one in Gujarat. Now the head office in Chennai receives common services. How do I distribute it? The head office in Chennai can distribute this credit. Head office in Chennai can distribute this credit to Andhra Pradesh, Tamil Nadu, and Gujarat registration by way of IST. But what is the proportion in which they have to distribute? They cannot do it in their own proportion. They will have to do it in proportion to the turnover of the place in the previous year. So they will take what was the turnover of Chennai, what was the turnover of Andhra Pradesh, and what was the turnover of Gujarat, total it as the denominator, and the numerator will be respective locations turnover multiplied by this common credit. And then it will be distributed to the 3 locations in proportion to their previous year turnover. Suppose one of the branch was not even there in the previous year. Then how will I distribute it? Should I wait for 1 year? No. For that, again, section 20 and 21 has got an answer. It says, in those cases, you can take the turnover of the previous quarter. So you don't have to wait for 1 year, you just have to wait for 1 quarter. You can take the turnover of the previous quarter as applicable, and in that proportion, the distribution can be done. And the distribution should be done for all those people to whom it is common, to whom it is relevant. The distribution should not be done blindly to everybody who is involved in the transaction. Who is not involved also should not be getting the receipt of the ITC. It is only those who are involved in the transaction should get the ITC distribution. That is what is promulgated in the Input Service Distributor discussion in section 20 and 21 of the CGST Act, read with Rule 39. So these are the provisions in relation to input tax credit in GST, which one has to be aware of. As I said at the start of the session, this is one of the beneficial piece of the legislation. Once an accountant is conversant with this, the accountant can say that GST procedural aspects, they have got a grasp over it, which will enhance your value as an accountant. Thank you all for your patient hearing. Now what I can do is I can get back to the Google Meet call and take any questions if it is there.
Thank you, sir. Dear
Yes.
participants, if you have any questions regarding the sessions, you can post it on the live chat box.
Should I see it in YouTube, ma'am, or should I see it in Google Meet?
So if they post it in the YouTube, I will just post it to you in the Google Meet, sir.
Okay, okay, right.
So there is one question in the YouTube.
Yes, ma'am.
Yes, I have posted it in the chat box, sir.
Please repeat sale of capital goods. Sale of capital goods, two calculations will have to be done. One, we'll have to take the capital goods eligibility of ITC. Rather, I would say ineligibility of ITC for the capital goods on one hand. And then on the selling price of the capital goods, what is the GST? Of these two amounts, the ineligible ITC and the GST on the selling price, whichever is higher, will have to be paid to the government. How to calculate the ineligibility of ITC on a capital goods is, we are entitled only for 5% of the ITC per quarter on case of capital goods. Does it mean I will take only 5% every quarter? No, you can take fully on the day one, but you will have to calculate this 5% only on disposal. When you avail fully. But when you are disposing, we have to think that, okay, I was eligible only for 5% per quarter. So start calculating. 5% per quarter is what you are eligible. Then, if you had put it to use for 2 years, which would be 8 quarters, 8 into 5, 40%. 40% of the original ITC is what you are availing, meaning you are eligible. So remaining 60% is ineligible. 60% is, as I gave in that example, 10,800. To that extent, you will have to reverse input tax credit. Or on the selling price, whatever is the GST. As I gave in that example, if the selling price is going to be 20,000, GST is 3,600. Suppose if the selling price is 80,000, then in that case, 18% of 80,000 will obviously be more than 10,800. So you need to pay GST of 18% of 80,000. So that is where this provision influences the taxpayer to say that you have to use the asset for 5 years, or ensure that it is an asset which is going to fetch more value, not deteriorate at a faster value, more than 5% per quarter. That is the concept of capital goods disposal. The next question, if I am buying a lorry for my business purpose, I can claim ITC, sir. Yes, absolutely, you can claim ITC because lorry is certainly not a passenger vehicle. It is a goods carrying vehicle. Whichever size it is, you can avail ITC. How do recipient make out whether supplier has paid GST to government in respect of supplied goods and services for claiming ITC? If you are a registered person, he will upload the invoice against your name. You will be able to see in your GSTR 2A. If you are an unregistered person, you cannot verify as to whether that person is paid or not. But hold on, in next 1 year, that is going to come, where the government has slowly started introducing a concept called as e-invoicing, in which they are going to make the QR code as a mandatory field for all the B2C supplies. What is B2C? B2B is business to business. B2C is business to customers or consumers. So I am going into a jewelry shop and I am procuring an item. They are only selling it to me B2C transaction. Are they going to raise a invoice on me? Yes. And should they raise? Yes, they should. And they should raise it with a QR code. Okay, what is the purpose of QR code? What the government will do is they will allow us as consumers to scan that QR code and upload it to the government website. And what I am foreseeing is that they will say that if you upload invoices like this, monthly once we will conduct a lucky draw. Whoever invoices gets picked, that person will be given the prize. So most of us will look for the QR code and will start scanning and uploading. This will indirectly be an information for the government. They will find out, okay, he purchased from jewelry and he has uploaded this invoice. See whether that company has uploaded the invoice, the jewelry has uploaded the invoice. If they have not, they will go and grab that person. So I think that is what is going to happen in the near future, where we'll be able to dictate some amount of correctness in this, whether the collected tax is paid to the government or not. But today, if you are an unregistered person, you cannot track whether the other party is paid or not. Any other questions?
Yes, sir.
I think there is a question on, is registration mandatory for ITC? I'm looking at your YouTube. Yeah. Is registration mandatory for ITC? Absolutely yes. Because the definition of input tax credit itself starts with the words in relation to a registered person. And in section 16 also it is mandatory that only a registered person can avail ITC. And which is why we saw in section 18, so far you are not registered, now you are becoming registered. How to claim ITC on becoming a registered person? Hence, registration is the prerequisite for ITC availment. What is ITC? Once more, please explain. ITC is the input tax credit. Whatever tax you pay, you are entitled to take it as ITC and then utilize it for payment of your output. The first part of the presentation numerically even explained how that process happens. Do shopkeeper pay GST after purchasing goods from company or after selling them? That is purely contractual. See, if I am going to purchase from you, you and me agree that the sales term, the credit term is 30 days. I have to pay to you within 30 days. But you, as a person selling to me, at the end of that month, you are liable to pay GST to the government. So you cannot tell, since Shankar did not pay, I will not pay. It is your responsibility to pay. For example, I am procuring today. Today is 7th of November. Our credit term is 45 days. So I'm going to pay you only by, let's say, 22nd of December. But by 20th of December, you should have paid tax on all your sales invoices for November. So you should pay. I will pay you later. So that is purely credit terms between you and me. If you feel that GST you cannot bear, then what you can tell me is, Shankar, for the basic value, I will give you 45 days credit period. But for GST, you pay me immediately. That we can agree. Absolutely. Any other questions?
Yes, sir. I have posted it now.
What are the registration process of ITC? I'm not able to understand the registration process. You get registered in GST, that's all. It is like you have a GST registration number. That number, you will file return, and in that return, you will take ITC. That's all. There is no separate registration process for ITC and all. For GST complaints, you will have only one number. Common ITC. What is common ITC? ITC, which is availed, but the output is both exempted as well as taxable. That is what is common ITC. ISD, Input Service Distributor. ISD is Input Service Distributor. What they distribute is services related credit, which they have received, but that is considered to be common. Which they have received, which is considered to be common. Common to whom? Common to the other parts of the entity. If the other parts of the entity are also in the same registration, then there is no problem. But the other parts of the entity, like I gave an example, one is in Andhra Pradesh, one is in Gujarat, then the bulk of the credit for the common service would have been availed in Tamil Nadu only. So to avoid that, what the government has said is the head office in Chennai can have that further benefit of being able to distribute their credit. How can they distribute? This is the method. The method is called Input Service Distributor. They can get registered as an Input Service Distributor. Having got registered as Input Service Distributor, they can avail the ITC, and that ITC they cannot utilize. They can only distribute. In what proportion they can distribute? In proportion to their previous year turnover. And they can distribute it only to those people for whom it is common. How do shopkeepers run away from paying GST of in? Again, not able to decipher the question. How do shopkeepers run away from paying GST? Sir, run away from paying GST? There are many ways. See, compliance of law is what we should be doing diligently. Non-compliance can be done in any way. Whether Indian ITC and foreign ITC principles are in same lines or different principles, they are in same lines, internationally accepted. 172 countries have accepted this same kind of ITC mechanism only, which is what is utilized in, or which is what is envisaged and copied, pasted in India also. Same kind of ITC availment.
Dear participants, if you have any doubt, please post it on the live chat box. So there is one more question, sir.
If you earn job work charges, collect of it is 2 lakh. How much tax paid? Depends upon the type of job work. For example, if it is a tailoring work or a printing work, it is 5%. In case of leather also, it is 5%, depending upon what type of job work it is. Engineering work, they have reduced it to 12% now. So it could be 5, 12, or any other services, it could be 18%. For example, bus body building, those kind of job work, it can be 18%. When we have different slabs and foreign countries have single slab, how it can be possible? The logic is same. Input tax credit is whatever you paid, you will be able to take the ITC. Whether you paid 7% and output is 7%, or whether you paid 7 but output is 18, doesn't matter. So the principle of GST remains the same. Input tax credit logic remains the same. Rates are different in India. That doesn't mean there are no multiple rates in other countries. Every country has multiple rates. The common example that people tend to take is Singapore. Singapore is lesser than Chennai's population. So that I wouldn't call strictly a country. For that sized country, you can monitor everything in a day. So that way they can say that we have only one rate. But larger the country, larger the union, like an European Union, they don't follow a single rate. Different products, different rate. We cannot say we'll have only one rate. It is not possible because food items, food-related items, it has to be at 5% because it has to be given an element of reduction in price. But whereas liquor, or rather, I would not take liquor into consideration. Let us say tobacco. Tobacco, I have to charge the highest sin goods. So that is how the mechanism has operated in India. And when you look at the size of India, we had a discussion once with the Australian VAT authorities. In GST in Australia is called as VAT. 2018 February is when I interacted with them. That time I had asked them a question. When was VAT introduced in Australia? It was 1999. So I asked them, when did it stabilize? 1999 they had introduced, and it stabilized somewhere in 2006. Australia's population is lesser than Kerala's population. Now we are looking at a country which is 32 times bigger than Australia, and a system has been implemented, a method has been implemented, and we want it to work within 3 years, which has succeeded, I would say 70-80%, which has fallen flat in some of the areas, which they are correcting. But is there a precedence of an implementation of GST of such a huge volume across the world? No. And India takes about 1/6 of the population of the world. So anything implemented in India is a huge implementation. And that implementation takes its time to settle. That has different rates. Maybe the world will know from India that having differential rates is a good practice. So not having differential rates, having only one rate is certainly not a correct practice. And imagine US, considered to be the strongest economy, they don't have GST at all. In their country, they are still following provincial taxes. There is no central activities. Different things works for different countries. Okay. Please explain central tax distributed. Any ITC that you take. See, I am in Chennai. I have received an input tax credit of CGST of Chennai. Then how will I distribute that? I can distribute it to another person, that is my factory within Tamil Nadu, as CGST. But if I am going to distribute it to Andhra Pradesh or Karnataka, how can I distribute as CGST? In those cases, I will be able to distribute it as IGST. And the turnover of previous year or previous quarter, what does it mean? Previous year is the general turnover that we are supposed to take. Previous year is 31st of March of the last financial year when it ended. What was the turnover of that unit? Likewise, how many units we are going to distribute? Take that, and in that proportion, you distribute. Previous year, that unit was not at all there. Then we have to distribute it in the proportion to the previous quarter turnover. So that will ensure that that unit is not left aloof without getting any distribution for more than 1 year. It can maximum be 3 months. After that, you will start distributing for that.
So I think the question sessions are over, sir.
Okay. Thank you all again.
Thank you, sir. Thank you so much for being with us today. It was an enriching and energetic session, and we got another chance of meeting you and getting your knowledge shared with us. And it was a pleasure having you today, sir. On behalf of School of Commerce, Bharatiya University, Dr. N. Jagadishwaran, sir, and all the participants on live YouTube, we wholeheartedly thank you for sparing your time with us, sir. Thank you so much for being with us today. And we hope to have another session with you in the upcoming days also. Thank you, sir.
Thank you.